Welcome to the fourth episode of this market timing and stock picking course. Let's explain what market timing really means. In the previous chapters, we have seen that buy and hold does not work in real life, but now this means that you need market timing. So let's explain what is market timing. Many people confuse market timing with trend following. While both belong to the same family, trend following, as the name indicates, means that you follow trends, so you need a trend to exist to buy, and when the trend turns down, then you sell. But this is just one of the elements of market timing, because there is also what we call mean reversion. What is mean reversion? Mean reversion means that the stock market has fallen too much and then you bet on a reversal of this negative trend. Or it has gone up too much and then you bet that the uptrend is going to end. So this is mean reversion, and the two of them together makes what we call market timing. Because market timing is not dogmatic, it's not only trend following. No, there is a time for trend following and there is a time for mean reversion. So in my timing indicators, I use both. I would say that I use trend following 99% of the time. So most of the time we are in trend following mode, but occasionally there are really sweet spots when mean reversion works. And then it's the time to go all in when the trend is about to change because it's going to mean revert. So I'm going to give you the overview of market timing indicators. In other episodes, I'm going to give the specific of all of them. My first market timing indicator is the Dow theory for the 21st century. I give in the description of this video a specific Dow theory for the 21st century YouTube course I uploaded several months ago. So you can get all the information concerning the Dow theory for the 21st century in these videos. This is the tool number one. My second tool is what I call the blind timing indicator. The blind timing indicator is also trend following and uses three distinct measures to appraise the trend. The first one is the trend of margin debt. Margin debt is the amount of leverage that traders take in their brokerage accounts. For instance, I have, let's say, an equity of $100,000, but I buy stocks for a total of $120,000. Then I am leveraged 20%. And brokers are very happy to give me credit, to lend me money, to margin my account because they earn interest. So when investors are in risk on mode, so when they are really bullish on the market, they take on leverage. So they margin their brokerage accounts. And this is published every month by the FINRA, and every month they release the latest margin debt figures. And normally when margin debt goes up, this is a bullish sign for the stock market because it means that traders are really betting with their money, taking debt that the market will continue going up. And when debt shrinks, it means that investors, stock pickers, are really selling and closing positions, which has a bearish implication for the stock market. I have thoroughly researched margin debt from all possible corners, and it really has forecasting power because some people object, say, no, look, okay, margin debt does not have a forecasting ability because it simply tells you what is happening right now. But this is false. I have really tested in all ways possible margin debt, and it has a forecasting power, I would say even until 1 year, but very clearly for the next 6 months. In other words, when margin debt is rising, the implications are that the stock market is going to go up at the very least for the next 3 to 6 and even 12 months. Of course, the secret is how to appraise margin debt and how to measure it and how to derive conclusions. There lies the art of the trade. But be aware, margin debt is, I would say, 70% of my blind time indicator. So in other words, when margin debt is going down, shrinking, I will be very reluctant to go all in the stock market. It is not in itself a sell signal, but it's a huge yellow light in my blind time indicator. And if the other two factors don't align, then it will probably trigger a sell signal. The second element of my blind time indicator is what I call market health. Market health measures the ratio of aggressive indexes versus conservative indexes. I give you an example. The Nasdaq is more aggressive than the Dow utilities, or the S&P is more aggressive than the Dow transportation. So when I measure, I track the ratio of the most aggressive to the least aggressive indexes, and I standardize, and there is a ranking that goes from 0 to 3. A rating of 3 means that the aggressive sectors indexes are outperforming the defensive ones, and a rating of 0 means that defensive indexes are outperforming the aggressive ones. This index is telling me whether we are on risk on, risk off. And once again, it has predictive power. Someone could object and say, look, okay, it tells me that the market now is favoring aggressive sectors or indexes, but it tells nothing about the future. But yes, because you know that trends persist, and this is a very well-established fact. So when aggressive sectors are outperforming defensive ones, the most well-tested outcome is that they will continue outperforming the next 3-4 months. So this is the second element of my blind time indicator, which is market health. And then the third one is purely trend. I don't go into the details because it's proprietary, but it's just another way of measuring trends. So I measure the trend using confirmation. That much I can disclose. You know, I'm a very big fan of the principle of confirmation. So I use several indexes, and when my trend measures say on a confirmed basis that a trend is up, is the third element of my blind time indicator. So the buy and sell signals are derived by integrating the three elements. The trend of margin debt, 70%, I would say. Market health, let's say, is 15%. And the trend of the stock market, the other 15%. So then the blind time indicator integrates all these different readings, and it tells you when is the right time to buy and the right time to sell. Another element in my timing arsenal is the capitulation indicator, and this is mean reversion, because until now we have dealt only with trend following indicators, but we have the capitulation indicator that was created by Jack Shannon, and it's really something unbelievable. It has the uncanny ability to pinpoint significant bear market bottoms. And I will give you some figures that are really astounding. Capitulation describes moments when selling pressure becomes extreme. Fear dominates decision-making, margin calls force liquidation, and investors abandon positions regardless of value. This is often referred as a selling climax, a phase where emotional pressure and also financial need for cash exhaust supply. While the word capitulation does not appear explicitly in the classical Dow theory, the concept is clearly present. Because Rhea, in 1932, Rhea is one of the fathers of the Dow theory, said that when there is a selling climax, it might be the right moment not only to close shorts, but also to make a commitment, in his words, to long positions. So Rhea was acknowledging that while the Dow theory is trend following, there is a place, exceptionally, but there is a place for some mean reversion. Our capitulation indicator has used data from 1953. Using data going back from 1953, this indicator has identified 18 clear capitulation events. The results are highly consistent. On a median basis, capitulation was identified just 2.5 days before the bear market lows, which is really incredible accuracy. And it was only capitulation 1.6% above those lows. So in other words, it was only 1.5% above those lows, which is really unbelievable. In many cases, the signal occurred exactly at the market low, and in many others within 1 or 2 days. This is not about guessing. It is about recognizing when risk has largely been exhausted and opportunity is emerging. This is market timing in practice. Trend following when trends dominate. Mean reversion when extremes appear. In the next episodes, I will show you how these tools work together and how they form a complete and coherent market timing framework. So in this video, we have seen two very important time indicators, the Dow theory for the 21st century, the blind time indicator. These are the two cornerstones of my market timing approach. We have also examined capitulation, which is the joker in my cards that serves to implement mean reversion trades. And in the next episode, I'm going to show you also how I take trend following signals by using thrust, another vital tool of my trend following arsenal. See you in the next chapter.